Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of bull versus bear markets, what they mean and how to navigate them. Bull and bear markets aren't just buzzwords, they shape the way investors approach opportunities and risks. A bull market signals rising prices and optimism, while a bear market reflects falling prices and caution. These patterns are more than market trends, they're key to understanding how the financial world operates. Knowing the difference and what drives these cycles can help you make smarter decisions when it matters most. Understanding bull markets. Bull markets are like a breath of fresh air for investors, bringing a sense of optimism to markets and sparking economic growth. These periods are defined by rising prices, higher confidence, and an overall positive outlook, making them a central theme in the world of investing. Understanding what makes a bull market thrive can help you identify opportunities and prepare for long-term growth. Key traits of bull markets. Bull markets share distinctive characteristics that set them apart. Here's what you can typically expect during these periods. Sustained rising prices. A bull market is marked by consistently increasing stock prices over time. This upward trend often spans months or even years, reflecting strong performance across various sectors. Positive investor sentiment. Investors feel confident and are more willing to take risks, contributing to higher trading activity. This enthusiasm drives demand, which pushes prices even higher. Economic growth. Bull markets often align with expanding economies. Indicators such as GDP growth, increased consumer spending, and higher corporate earnings go hand in hand with market gains. Think of a bull market as a snowball rolling downhill, gathering momentum with each turn. Optimism begets more optimism, creating a self-reinforcing cycle that sustains upward trends for extended periods. Historical examples of bull markets. Looking at history can provide valuable insights into how bull markets unfold. There have been several standout examples of these powerful upward trends. The dot-com boom, 1990s, fueled by rapid advancements in technology and internet adoption, markets soared throughout the 1990s. Tech stocks like Microsoft, Cisco, and Amazon helped lift the entire market before the bubble eventually burst in the early 2000s. Post-2008 financial recovery. After the 2008 financial crisis, the global economy entered a long bull market that lasted over a decade. Unprecedented levels of government stimulus, low interest rates, and technological innovation drove significant market growth. Post-COVID rally. 2020-2021. Following the market crash in early 2020 due to the COVID-19 pandemic, markets rebounded sharply. Stimulus checks, accommodative monetary policies, and a surge in innovation led to record-breaking highs, particularly in tech and green energy sectors. These examples show how external factors, such as technological breakthroughs or monetary policy shifts, can ignite and sustain bull markets. Causes behind bull markets. Bull markets don't happen by accident. They're often driven by a mix of economic, financial, and societal factors that align to create a perfect storm for growth. Here are some common drivers. Strong economic indicators. When the economy is expanding, it builds confidence. Rising GDP, industrial production, and retail sales point to a healthy environment where businesses thrive, which reflects positively in stock prices. Low unemployment. Jobs are the backbone of any economy. When unemployment is low, consumers have more money to spend, boosting company earnings and driving further market growth. Technological advancements. Breakthroughs like the internet boom or advancements in renewable energy spark excitement among investors. These changes create new industries, generate wealth, and open doors to innovative opportunities. Easing monetary policies. Central banks play a major role by lowering interest rates and making borrowing cheaper. This leads to increased investment and economic activity, creating upward pressure on markets. Understanding these drivers can help you recognize emerging bull markets and position yourself to benefit. They're like the gears of a well-oiled machine, working together to create a favorable environment for investors. Understanding bear markets. Bear markets are the exact opposite of their bullish counterparts, often bringing a sense of unease and caution to the financial world. Defined as a sustained drop of 20% or more in major stock indices, these downturns are often accompanied by broader economic struggles. Recognizing the signs of a bear market and understanding what causes them is essential for making informed decisions during challenging times. Key traits of bear markets. Bear markets have distinct features, and knowing what to watch for is critical. Here's what typically defines these periods. Declining stock prices. The most obvious trait is falling stock prices across the board. This consistent drop can stretch over months or even years, impacting everything from blue-chip companies to smaller cap stocks. Negative investor sentiment. Fear often overtakes optimism in a bear market. Investors tend to pull out of the market, causing trading volumes to shrink. This lack of confidence can create a ripple effect, further driving prices lower. Economic contraction. Bear markets usually go hand in hand with economic slowdowns. Key markers such as shrinking GDP, reduced consumer spending, and lower corporate profits signal an economy that's struggling to grow. Think of a bear market as a long winter. It's uncomfortable and forces you to be cautious, but it's also a natural part of the market cycle, paving the way for brighter days ahead. Historical examples of bear markets. A look back at history reveals the impact bear markets have had on the global economy and the lessons they've taught us. Here are a couple of the most notable examples. The 2008 financial crisis. This was one of the most severe bear markets in modern history. Triggered by the collapse of the U.S. housing market and widespread failures in financial institutions, global markets tumbled. Over a year and a half, the S&P 500 lost more than 50% of its value. The dot-com crash. 2002, fueled by overhyped internet companies with unsustainable valuations, the tech-heavy Nasdaq plunged nearly 80% over 2 years. Many investors who had poured money into startups faced massive losses as numerous companies failed to deliver on their promises. These historical bear markets serve as a reminder that overexuberance and structural weaknesses often precede downturns. Causes behind bear markets. Bear markets don't happen randomly. They're frequently triggered by underlying economic or geopolitical issues. Here are some of the most common causes. Economic recessions. A slowing economy tends to hit the stock market hard. When GDP contracts for consecutive quarters, it signals a recession, leading to lower business profits and declining stock prices. Rising unemployment. High unemployment rates reduce consumer spending, which lowers demand across industries. This creates a chain reaction, hurting company earnings and pushing stock values down further. Geopolitical instability. Events like wars, trade disputes, or political unrest can shake global markets. Uncertainty makes investors more risk-averse, often leading to widespread sell-offs. High inflation or interest rates. Rising inflation reduces purchasing power, while higher interest rates make borrowing more expensive. Both factors can cool down an overheated economy, but often at the expense of market growth. Understanding these causes helps clarify why bear markets occur and how they impact the broader economy. While they may feel daunting, they're an inevitable part of the market cycle and can offer opportunities for those prepared to act strategically. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.